Hey, everybody. Welcome to week 139. Or no. I'm being dyslexic on those numbers. It's 193. And by the way, the week anniversary of 200, our 200th week anniversary is coming up March 28th. And I think we might be doing that a live one again, maybe even at the karaoke bar at 820, or formerly the place formerly known as 820, now known as the Hamilton. Same owners, the Tatios. So anyway, we'll see about that. But today's going to be fun because yes, we have a former IRS agent in the building, or at least on the screen, Andrew Bosserman. So he's a tax attorney over at Shoemaker. Love those guys. And Andrew has been on here. Yes, Jack did get younger. Joe.
I mean,
Yeah, Jack.
we love you, Andrew, and the resemblance is uncanny in some respects.
Oh, yeah. So Jack gets a hall pass today. He's doing some sort of a seminar somewhere or whatever that he couldn't get out of, and so he may even harass us in the chat too if he has a moment. So we gave him the registration link that everybody beyond panelists have. So we did get a question that has come in here, so we're going to deal with any questions that you want to ask that you're afraid to. You can remain anonymous if you want. That's fine, but we'll also have probably some additional insights and some more stories from Andrew, because I understand that you may have had some ERC related issues that you've had to deal with. That should be interesting. Derek Painter said yesterday, he's like, man, those stories are always good. So we've had Andrew on here many times as the confessions of a former IRS agent, and that's always been fun and enlightening. So before we get into one of these pretty detailed questions that is like a uh-oh, and Andrew has already indicated that this is more in his wheelhouse than Adam's wheelhouse, so we'll get into that. I'm going to toss the ball over to Adam. Adam, with regard to some of this legislation that we've been talking about that's been pending, that may be coming down, that some of it has come down, do you have any updates on any of that you want to hit us up with first?
Other than to express my frustration, no, that something that passed with overwhelmingly bipartisan support in an extremely partisan House somehow has not been taken up by the Senate with no kind of timetable of when it's going to get taken up. So I don't know. I would really hope that to save the embarrassment of what just happened on the border Ukraine Israel deal. I would hope that they say, hey, let's give the country a win and get this passed in the month of February. That's all I got.
Okay, that's good. Also, then Andrew, go ahead and introduce yourself besides my feeble introduction, and then I'll toss this question that we got this morning in and have you go into it, because I know that the person that sent this is probably not the only one that has dealt with it or may deal with it.
Thanks, Gary. Yeah, it's great to be back, and always enjoy talking about my time at the IRS and also just any tax or other questions you have. So my first job out of college actually was an IRS agent auditing small businesses. And then I also worked as a CPA for a little bit in a regional public accounting firm, and then decided to go to law school. So now I work as a tax attorney. I do some corporate work, but also focus on tax and especially a lot of tax controversy. Recently, there's been, I'm working on 4 ERC audits right now, Gary alluded to, as well as other, anytime people have issues with the IRS getting, trying to get penalties waived, other audits, working on a payroll tax audit now, all sorts of things, not not filing, collections, so the whole gamut. And also, fun fact, I used to own a small Christmas tree farm for a few years. So if you have any questions about Christmas tree or timber taxation, I'm your guy as well. So.
Oh, I am so glad that you brought that up, because this question came from somebody that is in the lumber world, and I'll just leave it at that. So you know who you are on here. I want to kind of keep this anonymous. So you know who to reach on here. His name is Andrew Bosserman. So here's the question. I'm going to tee it up for everybody. Was informed yesterday that because we had not provided healthcare benefits to our employees, we're getting dinged with a fine of $7,000. Also learned the company could be dinged for another $97,000 fine under the Affordable or Unaffordable Healthcare Act, aka Obamacare. And I will also echo those sentiments, because when I was unemployed, Obamacare and the Unaffordable Care Act was like $1,800 a month with a $13,000 deductible. As an unemployed person, that pretty much sucked. So I didn't see how it was affordable. Anyway, so did some recon and believe that there's a loophole, but that's to be determined by legal and preferably not a slip and fall legal eagle. So Andrew Bosserman is not a slip and fall legal eagle. First, according to the Obamacare and I guess the IRS, we're considered a large business with 55 or 60 employees. Yet, as far as access to capital and valuation multiples, we're treated like a redheaded stepchild in the lower middle market, meaning we don't get 10 to 15 multiples, times multiples like our publicly traded or even big private companies. We get 2 to 4. Okay. 2, I thought that the elephants back in 2017, when the R's had the House, Senate, and White House, took and dispensed with this issue. Apparently not. 3, who in our circle of professionals, such as our legal, former CPA firm, insurance agents, bankers, etc., should have been on top of this matter? Or was it a failure of management? Or third possibility, is it an issue of both of these things combined? Or maybe number 4, did I fail in my role? So there's a lot to unpack there. I did send this note to Andrew and to Adam ahead of time, because this person got us this series of questions ahead of the webinar. But Andrew, I'll let you unpack this and put your light on it.
So first of all, these types of situations involving the Affordable Care Act, counting employees, they can be very fact specific. So you really want to consult with someone knowledgeable. For example, like at Shoemaker, we have an employee benefits attorney, and he deals with this frequently. So definitely recommend getting specialized counsel with someone familiar in this area. But
So before you go on to that, if somebody wants to do that, when you have a break, would you put the name of the person at Shoemaker so that whomever can go ahead and put that in the chat to everyone?
Yeah, I'll put it in there. His name is Clay Williams, but I'll go ahead and I'll type it in there. But so yeah, it really gets down to that if you're an employer and you have more than 50 full-time equivalent employees, generally you must offer health insurance to your employees. And that's been the law since Obamacare came on the books. What did change was a number of years ago, what they call the individual mandate went away. And that means that you as an individual essentially can't get penalized for not having health insurance. For a few years that was around, and there would be like a penalty on your tax return if you didn't show that you had health insurance. But that's what was changed in the years past. But what didn't change was that if you're an employer and meet all the requirements, you still need to offer health insurance to your employees. But the calculation of getting to 50, that might be what the question asker was getting to, talking about a possible loophole or getting around it, how you count those employees, because you might have some part-time employees or, there's other exceptions. That's where the count, especially it sounds like you're very close to 50. So that's why you want to have someone take a look at it to make sure you actually meet that threshold. Also, since there's penalties, there might be ways to get those, waived or reduced. And we do that a lot of times with clients. And, the IRS can sometimes be nice about, if you come into compliance, they'll, help you out on the penalties, but nothing's ever guaranteed.
All right, that's really helpful.
Oh, and also, if getting to the, unaffordability or the high cost of providing healthcare, one thing you might want to look into is a PEO, a professional employer organization, and that's essentially where employees are grouped together in a larger group to qualify for, lower rates on benefits and things like that. So you'd still have the same employees. It's just they wouldn't be on your tax return, but they would still be, common law, your employees. So
Yeah.
That's a great point. Go ahead, Adam.
I was going to say that, so there's very few items that will get me on a rant faster than discussing the cost of health insurance. So, all the Affordable Care Act did was made something that had become increasingly unaffordable. It just stopped increasing as fast. I mean, honestly, just to put it in the way back machine, the first time I started to get super angry about health insurance costs is that, when we started the company back in 2007, needed health insurance, for my family, and we were like, well, we'll be benevolent employers, like let's offer, if we're doing benefits for ourselves, let's do benefits for like all in. We did it all, fully funded, HSA, everything. And then, someone else took over the bill payment after a while, and I stopped, being involved in those kind of decisions. And about 3 years later, I went to go use my HSA card. And remember, at that time, I think we're paying like $1,000-1,500 for me and my whole family each month, which was ridiculous, but that's what it cost at the time. So I went to go use my HSA, and there was no money in the account. So I went into Andy, and I'm like, dude, why aren't you funding my HSA? And he goes, because we don't have the money to do that, because we're paying $1,500 per employee. I'm like, are you telling me in 3 freaking years we went from being able to fully fund an HSA to not? He's like, yeah, we don't even cover the full cost of family coverage anymore. I mean, keep in mind, this is in 2009, well before the ACA. So it's just, as I said, all it did was it stopped. In other words, let's not have any kind of misconception that health insurance has been affordable since probably 1990, period. So anyway, to Andrew's point, sorry about the soapbox there, Andrew. It's like, wow, I'm coming on one of these things again. But to Andrew's point about the employee count, just to hit on that a little bit more, and he had some other questions around, why wasn't I informed of this? On the employee count, the exceptions are really around, as he mentioned, part-time and hourly employees. But so you think sweet exception, but remember, like, I think 32 hours a week is like your value. So it's not even 40, it's 32. And you can end up getting stuck with the IRS got wise to that. They're like, well, you know what I'm going to do, Andrew? I'm going to cap your hours. I'm going to have 100 employees. I'm going to have 100 monkeys typing 1 hour a day, and I will produce the greatest novel the world has ever seen. Well, they got wise to that. And it's like, you have to actually aggregate part-time employees to come up with a full-time equivalent. So that shockingly thought through a couple of the obvious loopholes that existed. And really, on based on our experience, the only exception to this rule is the seasonal employee, which is going to be, farms, amusement parks. You can make a case for seasonality in the restaurant business. So you got a couple, options that exist for you there. But other than that, it is what it is. And if you remember, I think the question was, didn't the Republicans do something about this? No, they didn't. They had a shot on the goal and they didn't get it done. And if you'll remember, it's because John McCain, right before dying, came in and gave it the thumbs down.
Oh, that's right.
Primarily because there was no replacement option that was offered up. So he's like, why would I vote yes to something when there's no replacement option that's been offered up as a suggested alternative? So anyway, it is a soapbox item for me. But in terms of, who should have let you know, I don't know. Like I'm just thinking through, like, I feel like we're pretty good about that stuff. Yeah, I'm sorry. I feel like we're pretty good about knowing the rules, and I'm trying to remember it. I'm trying to think. Look, if Gary was my client and Gary just went over 50 employees, would I even know that? As a CPA, I don't. I don't know how I would easily know that, without asking the question. So it's making me think through, like, should I have a checklist item? So yeah, Joe, that's funny. Wasn't that when the 20-hour employees came in vote? Yeah, that was the scam, is let's just have 20-hour employees, but then they got wise to that and said, well, you got to pool them together to see how many FTEs that you really have. Yeah, so I mean, it's hard to say. I mean, it's kind of, I think most of the people like me would have thought, how do you not know that? Like, I'm not trying to be offensive. I'm just saying, like, it's been out there for so long, you sort of take it for granted that, well, not everybody knew that 50 was kind of the magic, was the magic number, that we needed to be monitoring because it hadn't ever really changed. So box done. Sorry, Gary.
So no, it's all right. A couple things. First of all, Andrew brought up a great point. I think we ought to have Jeff Warner back on here with Pair PEO, because that PEO landscape, or professional employment organization, where it's co-employment, basically you get to get the pool of a much larger insurance pool, so it drops your premiums. Now you also pay for administration of certain HR benefits and that sort of thing. So and it can be very confusing, actually, because everybody has their own little spin on it, and they are coming to sell you their specific program. What I like about Pair PEO is they're completely independent. You don't pay them a fee. All of these other PEOs pay them, the one that you end up choosing if you choose, but he's a straight shooter. That's what I like about him. And if it doesn't make sense, he will tell you it does not make sense. But in this case, you would also think, hey, if you had a payroll provider, which a PEO incorporates that as well, that would be a trigger for them. But if you're doing all that payroll internally, which I suspect is the case in this specific case, you wouldn't have that additional kind of catching, screening criteria. So just a thought there, but you know who you are on this call, and reach out to Clay Williams at Shoemaker. I did put it in the chat for everybody. So Andrew shared that with us, and so we're sharing it with all of you guys. So go ahead and go there. So Andrew, what I would really like to do, whenever it's funny, when I did this post about the IRS coming knocking, and people are like, man, that's scary. It's terrifying when the IRS knocks, right? let's talk about some of the basics. And I know you've covered some of these things in the past, but I'm now also assuming that there's some people on here today that may have not been on some of the former confessions of an IRS agent. Let's talk about some of the misnomers or the things that you really should know, like, hey, this is so and so from the IRS, Mr. Frey. You need to, like, seriously, what do you do about that? Or hey, I got an email that had a bunch of misspellings in it, but they said they were from the IRS and they were going to seize my bank accounts. What do you do about that? Let's talk about, how does the IRS actually contact you versus all the scams out there? What should you do? And some of the other, like, we'll get into some more of the misnomers or the myths about, oh, well, if I file early, then I'm gonna get dinged, or if I file late or I file an extension, then I'm gonna get audited. So kind of the mic's yours to take it wherever you want to go on that, Andrew.
Yeah, so the first thing to note is that currently the IRS, is only going to contact you by mail initially. Actually, when I worked at the IRS a little over 10 years ago, I would actually cold call people and tell them they were being audited. But surprisingly, people were suspicious of that, or most of the time it'd be like, okay, I'll follow up with a letter in the mail, and it'd come from me looking official. But the IRS stopped that just because there's so much, you know, identity theft out there nowadays. So the IRS, if you've been selected for an audit, they're going to contact you via mail. So if you receive a call from someone, ignore it, or an IRS employee will also have a badge number that they'll give you. You can call the main IRS number to verify their employment. I do know there was a recent instance where I think a North Carolina Department of Revenue agent reached out via email about an audit to someone, and you know, we verified the agent was legitimate and an audit was going on. But what I just talked about was the IRS's protocol. Sometimes state and local agencies have different protocols, but it's always good to verify just because of all the identity theft. And the way, there's a lot of, if you Google, red flags for an IRS audit or something like that, you'll find hundreds of articles where people say, oh, don't do this, don't claim business use of home, or all this other stuff, file early, file an extension, etc. No one really knows for sure except for the IRS themselves, because to select returns for audit, they have this, secret algorithm they use. It's called the diff function. But anyways, your return goes through this, and people think it gets compared to maybe prior year returns, possibly other returns of people in your same income brackets, or if you're a business, same industry, and tries to match up things that are wrong, etc. But no one really knows for sure. So it's hard to say what's a red flag. If you have a legitimate deduction and are entitled to it, I say, take it. Make sure it's well documented. That way it's easy if you ever do get audited. But I don't think a concern about a potential red flag should prevent you from, claiming a deduction or lower tax rate or credit or whatever it is, just because you're worried about the IRS audit, because there's plenty of people out there like Adam and me that can, are experienced at going through IRS audits and can help you through the process.
You mentioned something earlier that we've seen that a lot of people don't know, and that is, oh gosh, I got hit with this massive penalty and fee. Oh my gosh, I can't pay for that. What am I going to do? Call Optima Tax Relief? Well, wait a minute. Before you do that, we haven't had that, and it's not Optima. It's probably with any of them. Our experience with them hasn't been so great, but what we would say has been quite good is, between a good CPA and a good tax attorney, they're on the phone pretty regularly with the IRS, with the Department of Revenue from the state, a lot of times those fees can be waived. It's not like they can waive them all the time, but many times they can be waived or reduced. Correct, Andrew? You want to expand on that at all?
Yeah, a lot of the times they can be waived. You generally have to provide some sort of, they call it reasonable cause, but essentially coming up with a good argument why it was reasonable for you to have not filed your return timely or forgotten to pay some taxes, etc. And also there's what's known as first time abatement. So for many IRS penalties, if it's your first time, it's kind of like a get out of jail free card. You say, hey, sorry, I screwed up. This is my first time, etc., and the IRS will generally waive it. The important thing to note is that generally, in order for the IRS to waive penalties, you must be current on everything. So that means all your required tax returns have been filed, and also you're current on making estimated payments, which is critical if you're a business and have to make them separately. But yes, there's a lot of instances to get them waived, either once they've been assessed or even, once you get on the collections route, there's, say you have taxes, but you can't pay it all. There's ways to get an installment agreement to pay taxes over time. There's also what's known as offers in compromise, essentially settling with the IRS for a reduced amount because you can't pay the full amount. And there's a few other ways possibly to, reduce or minimize tax debt, but those are just a few of the ways.
All right, that's good. Now, this is another little random question, but we had a guy on the Anything But Typical podcast that's a business owner in Charlotte, and he had a terrifying moment when the IRS actually did knock on their door, came in, went through all their stuff. And that was the first time I'd ever heard of the IRS doing that. And supposedly, according to this guy, it was completely unannounced. Now, could he have, or his business manager received letters and didn't do anything about it? I don't know. But does that happen, Andrew?
It's possible. So there's essentially two sides to the IRS. There's the civil side, which is what I did. I was what's called a revenue agent, and you're auditing tax returns. And essentially, if you didn't pay or anything, you might owe money. But then there's the criminal side, and the IRS has a whole team of criminal investigators, and they're essentially law enforcement, just like police or FBI. And in that instance, it could be criminal investigator agents because they don't have to, they can show up unannounced and they would get a search warrant through the normal legal procedures. It'd be like the police showing up at your door with the search warrant. So that sounds like likely what probably happened in that instance. It's hard to know without knowing more, but the IRS has essentially all the powers that, the FBI or police would have, to, do a legal search of your residence or business.
Okay, cool. Yeah, it was just unusual because it was a marketing firm, and I think they were looking for something. I mean, he was clean, but it was very unnerving for him to go through that experience. So, anybody that's got questions, this is your hour. Feel free to hit us, and you can remain anonymous if you want. That's fine. If you don't want to remain anonymous, that's okay too. But now's your time. And while we're waiting for some of those things, Jack had mentioned that you had some ERC stories of late, and I'd be curious as to what you can share with regard to that, because we've been, from the time that ERC kind of came out, we felt like, man, that's going to be a heat-seeking missile for the IRS. You better be buttoned up, because immediately there were scam artists coming out. Hey, you qualify for the full amount. It's just easy peasy, instant money. And there were a lot of scams and a lot of scamsters out there, quite frankly, that we still get phone calls, and we are completely ineligible, but they're still persistent saying, hey, you qualify. So I'd be curious as to what kind of things that you've been working on and what kind of things you've found, and anything that, if somebody listening and watching this has taken ERC money and then they start getting nervous, like, what should they be doing? So Hit us up with that.
So I've dealt with a number of ERC audits. I did 2 last year that have been resolved. But just recently, I'm currently working on 4 because in January, the IRS seemed to have sent out the flurry of letters to taxpayers to audit their ERC claims. And what's interesting about these letters is that they all came from the Austin, Texas IRS office. Agent isn't assigned. You just get a list of information you have to provide and you send it back in. And the thought is, no one knows for sure, but that perhaps a lot of people won't respond, meaning that their ERC claim will then be denied. Or if they do respond, maybe a full audit will commence. Maybe if everything looks good, the IRS will just approve the claim, but they're definitely starting to audit ERC claims. And the important, what you can do to prepare out there is just make sure you have all the documentation to support the ERC if you received it. There's really 2 ways to qualify, either a substantial decline in gross receipts, but oftentimes where the gray area is if you had a partial or full shutdown due to a government order. And it's really important to know what that government order is and be able to tie it to your operations, especially now that we're looking years back, because I'm having to talk with people and saying, okay, so what happened back in 2020 and 2021? And, it's hard to remember, go back and find information. So it'll be interesting to see how those get resolved. I'm sure there'll probably be more coming down the pike. There are 2 current ways. The IRS is still allowing you to withdraw your ERC claim. Say you filed it and think you're no longer eligible. There's a withdrawal process. And also if you've received ERC money, but think you weren't eligible for it and want to pay it back, there's also a voluntary disclosure program where you just have to pay back 80% of the money you received, and the IRS agrees to call it good. But I do think one important thing to note is that even though you maybe used a shady ERC firm, that doesn't mean your claim isn't legitimate. There's obviously lots of legitimate claims out there, but there's also lots of bad actors. So it really depends on the individual facts and circumstances of your situation. But we've seen, I think it was in January also, the IRS sent out a bunch of letters denying clearly fraudulent claims for, individuals claiming the ERC and didn't even have any employees or didn't even have a legitimate business. But there's lots of, legitimate claims out there. It's just the IRS has to sort through, all the massive claims from all these tax credit firms popping up.
Yeah, if I was going to suspect, I don't foresee this being a scenario where, because they haven't ever done something like this in the past, where it's like, let's, like an insurance company would. You know what my answer is to you, Gary? Deny.
That would be an insurance company.
I'm gonna bet on the fact that you'll lose momentum on me denying you, and I'm gonna wear you out. I don't think that'll be the case. I think, to Andrew's point, there'll probably be some random audits that occur, just to sample, like, hey, I wonder what the, what the fraud rate is based on a random sample. That could be a case, because that kind of informs them how much fraud really is in existence, basically. So in other words, if they pull 100 people and they find, one fraudulent case out of those 100, then they would say 1% are fraudulent. Now let's figure out, if we can do some rhyme or reason to discern what created the fraudulent return. That'd be one thing. I think the other thing that they would do, which would be a no-brainer and could be a very legitimate outcome, would be a scenario where the number of employees that you claimed for the credit, for whatever reason, didn't foot to other documents that were available in their possession with respect to your employee count, like your census, for your 401k or health insurance benefits plan, or, for whatever reason, the belly buttons you reported on the 941s were different, than what you got in your claim form, because there's, there is some, disassociation that exists between those things. So those would be cases that I would see, I mean, I would have a question. If I were writing the algorithm, that'd be the kind of algorithm I would write. To go say, tell me more about this. Because that's actually very consistent with what we found with the the relationship between PPP and then the other people that were eligible for the FFCRA credit, which was the medical leave credit that was available at the first part of the CARES Act, associated with giving people paid leave time to recuperate from COVID or to get tested. Like, we had a lot of questions about that within our client base to claim that credit.
Here's a question for you, Andrew. How many years should you really be holding on to all the returns and all the documentation in case of an audit?
Yeah, so oftentimes people just recommend 7 years just to be safe. But just so you have some background on why they recommend that, generally the statute of limitations on tax return is 3 years from the later of the date it was due or the date it was filed. So for example, you're filing your 2023 tax return due April 15th, 2024. Say you file it timely, the IRS has until April 15th, 2027 to assess any additional tax. But there are some exceptions for if you omitted, a decent amount of your gross income. There's an exception for fraud, but in general, people just recommend 7 years to be safe. But you should always keep copies of your tax returns and also W-2s as well. Sometimes the Social Security makes mistakes when calculating Social Security, so I would keep those forever. Tax returns and W-2s. Otherwise, generally after 7 years, you can be assured pretty safe. Although there might be other reasons you need to keep records, say for bank loans. They sometimes have audit rights or reasons you have to keep documents. So 7 years is a good guideline, but just know there might be exceptions.
Okay, that's great. Yeah, that's helpful.
We had a chat from Deborah Whalen. I have a long-term employee at my business who is running into a really tough situation. She hired a local accountant from her hometown to do her taxes for 2023 since she had some unique circumstances. I'm assuming that's calendar year, and the actual tax year was 2022 because we're currently in tax year 2023 right now. She also had some debt consolidation. Local accountant didn't complete her taxes until this week, ignored all phone calls. Doesn't know what extent she might owe. So I think in this particular situation, I mean, if you wanted to be mad about it, if it's a licensed CPA, you can report it to the state board. Like you could do that. Then there's like a mandatory investigation that happens associated with that either gets closed in your favor or not. That's not really going to do anything about the taxes. On the taxes, the first thing that you want to figure out is, are they actually right? Because with the way that, depending on the nature of the debt forgiveness, you only recognize debt forgiveness income to the extent that you're in the money, and the only time, in other words, like, if you're worth negative 100 grand and you owe 200 grand and all that 200 grand is forgiven, you're 100 grand in the money. So in most cases, the only scenario where that's going to be the case is where you actually got to keep the underlying asset. So my point in saying all that is you want to make sure that you didn't pick up debt forgiveness income that you actually didn't have to pick up, because you weren't actually made solvent in the process. So that's question number one. Number two is with respect to taxpayer relief. Kind of talked about it at the beginning when Gary, rightfully so, made fun of Optima. And I'd see if Andrew's got an opinion or some guidance on this, but in my experience, nobody gets out of crap other than the penalty, unless like death is imminent. You know, like I've thrown every possible hardship on the planet to try to get actual tax and interest lowered, and I have failed. I have never met anybody who actually got actual tax and interest lowered. So I don't. Instead, they've just written out the clock, you know, the statute of limitations, and just kept on changing their bank account. So I would be, depending on the circumstances, probably not going to get out of it if it's actually owed, and the best you're going to do is get into a payment arrangement.
Yeah, no, I agree. I mean, penalties generally get waived. We talked about first time abatement earlier, or giving a reasonable cause argument, but I agree. Like interest, never gets waived. You always have to pay interest on any tax debt. Same with tax. I mean, it's possible to do an offer and compromise and settle, but what the IRS looks at is a very, like what is the bare bones amount of income you need to sustain your lifestyle, and essentially everything else over that they're going to say you can apply to your tax debt. So it's not impossible, but it can be fairly difficult to qualify for that. The other important thing to note is that assuming, I assume the penalties have already been assessed, but sometimes people think they're going to get a penalty for late filing a return. But if they were due a refund from the IRS, there's actually no penalty, at least for most income tax returns, because you actually gave the U.S. Treasury the benefit of your money for additional time. So generally, penalties are based on the amount you owe.
Yeah, that's good to know. Anything else? So yeah, thanks for getting that. I'm sorry I missed that in the chat, but thank you, Adam.
And also I'll say is normally that by signing the return, generally the IRS's position is saying, hey, you reviewed everything on this and you're responsible for your own return. Like you generally can't blame the tax preparer for a mistake. I mean, maybe in some instances, but the IRS will generally say, hey, that's between you and your accountant. You're the one signing the return. Like it's your tax return. There are exceptions, but that's the general rule. So that's why it's also important to, review your return before it gets filed and try to understand, to the best extent you can, understand the tax return, because accountants can make mistakes, or if a number looks out of whack, your business. So if something's looks wrong, I mean, definitely ask questions about it because you can avoid issues in the future.
Aside from some of the ERC stuff that is kind of rolling down the tracks right now, are there any other trends that you're seeing, Andrew or Adam, in the last couple of years with regard to the IRS versus years before, let's say before COVID?
I mean, I haven't really had any, but partnership audits are heating up. So that's, if you file a partnership tax return, so generally you're a, multi-member LLC that elects to be taxed as a partnership. The IRS changed the rules a number of years ago to make it easier for them to audit partnerships. I was at a conference last summer talking about this, and they're trying to hire as many partnership tax experts as they can. So I think we'll start seeing more audits of larger and more complex partnerships. What else have I seen lately? Employment. I'm dealing with an employment tax audit right now, and it's important to get your employment taxes right, because oftentimes for employment taxes, there can be personal liability if you're the responsible person, i.e. normally the business owner. Whereas for other taxes, you might not be personally liable, but for employment taxes, you can be. So it's important you get those right. Oftentimes, I mean, I generally don't recommend you do payroll yourself because there's so many ways to screw it up and get in situations. That's what I'm dealing on now. They did payroll in-house through a QuickBooks program. Essentially, they paid the taxes, but the returns never got filed for whatever reason. But it's trying to sort out all the deposits, get the returns filed. Oftentimes, although it can be somewhat expensive, it's probably worth the money to pay a professional payroll company to do it. Also, going along with the ACA healthcare question we had earlier, we've also dealt with companies failing to file. It's called Form 1095, but every employee you give health insurance to, you have to prepare a tax form that says they had health insurance for such and such months. Although we mentioned the individual mandate is gone, meaning the individual doesn't get penalized. For whatever reason, the IRS still requires you to file this form. And I'm currently working on a client who got assessed hundreds of thousands of dollars of penalties for not filing these forms, trying to get those refiled and waived. So just something else to be aware of.
Yeah, that's good. Adam, you seen any other trends recently?
You know, other than, I think we talked about it before that, there was a data breach that happened with the IRS. So there were some instances of identity theft. It was internal too, which sucks. So there were some instances of identity theft that were very, because they used real tax information to file the tax returns, versus just some random stuff. So they're very close to what was actually filed. We're still working through a couple issues with that, but that's not related to an audit. Outside of that, no, we haven't seen any trends. I think the key thing to reiterate, for the people that haven't heard Andrew before, is that, people always ask, am I going to get audited if I do this? Or is this going to raise a red flag? Or is this going to, and the honest answer to that is, based on my experience, I'd love to hear Andrew's take, is that it's not that there are no red flags. It's just that red flags are typically pretty freaking egregious. And our clients don't do egregious things. We do legally aggressive things. So there's never, every time we've had a client that got audited, we always ask, what was it? And the answer is always random. Like either they fell into this sample or they fell into this sample. The only time anybody's ever offered an explanation for the audit was a scenario where we had a client that never gave us information on time. So we filed a return that they said, hey, would you file this so we can avoid the late filing penalty associated with K1s? And it wasn't right enough, relative to what they ultimately admitted and filed. And they did that for years in a row, and finally the IRS was like, enough of this nonsense, in terms of like, that was something that they looked at, so that's really the only time I've ever heard of a cause for something that happened within our client base. And in that scenario, we told the client they're wrong. They knew they were wrong, and they weren't going to do anything to change it.
Yeah, and I think it's also important to distinguish a red flag from just something that's often frequently audited. Because, for example, when I was an IRS agent for small businesses, I felt in every audit you always looked at travel expenses, car and truck expenses, meals and entertainment, just because it's not so much people were, trying to skirt the law or whatever, but the rules regarding those can be fairly confusing, and a lot of people just get them wrong. So, or just don't keep good documentation because, for example, for car and truck expenses, you should always have a mileage log. For meals and entertainment, like, you should keep track of the business purpose of every meal. I'm sure not all of you out there do that because, can be cumbersome in timekeeping. But there are certain things that get audited a lot just because they're frequently missed by taxpayers.
So here's a question regarding the Form 1095. So there are health share options that are not insurance, right? So MediShare, and there are other, faith-based, non-faith-based medical sharing alliances. So it qualifies under the Affordable Care Act, from what I understand. If you've done that, if you're a sole proprietor or you've got a Schedule C kind of income, can you deduct those premiums and out-of-pocket health care costs?
I'm trying to remember. I haven't really run. Adam should know. Adam might know
Yeah.
this off the top of his head.
Yeah, so that's kind of a multi-part question. So basically these are, when Andrew referenced consider using a PEO if your health insurance costs are too expensive. This is the same concept. Basically I'm going to go into a health insurance co-op, and it happens to be, faith-based or whatever, for whatever reason that they've got
Yeah.
some sort of special qualification status. And the question is, can I deduct those? The answer to that is, yeah, because I mean it's still considered health insurance, so you treat it just the same way from a deductibility standpoint. And then if you happen to do that for over, the thing about it though is that you just if you're below the reporting threshold of 50 and you're trying to do the employees a solid, like, hey Gary, man, I signed us up for this health. This is where you gotta be careful. Hey Gary, I found this co-op thing that's awesome, dude. All you gotta do is say that you're Hindu and you're in, and you get, I'm joking with that, by the way. No offense to my Hindu friends. And you're in, you get great health insurance, blah, blah. And you know what? Out of the kindness of my heart, I'm going to give you $500 a month to be in it, like do your thing. Okay, unless that came through Gary's W-2, the IRS would probably deem that a health plan, like just a disguised version of a health plan. Thus, Gary would not qualify to buy insurance on the exchange. So, you just got to be super careful with the characterization of any sort of, I want to do the right thing and help Gary with his health insurance costs, but at the same time, I don't want to provide health insurance because it's too freaking expensive. You end up, unless you do it correctly, you end up violating the exchange rules such that Gary can't get his own insurance and receive any form of subsidy or discount. And so what's the way around that? I mean, it can go through Gary's payroll and be subject to tax, but now instead of Gary making, $40,000 and qualifying for a subsidy, ironically now he makes 50 and doesn't, so it wholly defeated the purpose. But the other way to do this is that Gary, I would like to talk about the benefits of working for VGW in your capacity. And one of those is, you travel a lot, and we did the cost benefit analysis, and we have decided that we want to start reimbursing you for your car allowance. So not reportable income to Gary, or it's reportable, but maybe not the same as the insurance premiums, depending on how I structured it. I still got Gary the money, that he needed. I just did not call it a healthcare reimbursement arrangement, which would otherwise violate the rules of the exchange.
So you actually bring up something that I think is interesting. And that is because of my role in the firm with business coaching, but especially my role in business development and qualifying the right businesses and et cetera, we see a lot of stuff from other CPAs and et cetera. And I'm like, and routinely we have prospects that become clients go, why didn't they tell me about this? Well, my answer is always this. It's a very complex tax code. And we've had some that were ready to go sue a partner of a big firm in New York because we found them hundreds and hundreds of thousands of dollars that they had just missed and missed and missed. And he was mad, he felt betrayed, et cetera. So I'm like, wait a minute. It's a complex tax code. And most CPAs will self-select into the most conservative position in the spectrum that's, on one end of the spectrum, I feel guilty for being a capitalist, so I'm going to send the IRS extra money with each quarter, to the other extreme of like, here's the line of the ethical and legal boundaries, and I want to dip my toe into that. Well, we aren't going to do that. We're going to, our guys aren't going to, and gals aren't not going to lose their licenses. Plus it's, I think we have ethical people working for us. So, but there's a lot that's in there. And I think it does make sense, whoever your CPA firm is to be challenging them and saying, is this the best that you can do? And if you feel like somebody's just taking such a conservative position in the tax code, get another opinion. It's just amazing to me. And it doesn't mean that all of a sudden you're opening the gates for audit risks and that sort of thing. We're really careful about making sure that if we're going to provide a solution, one, that you better be buttoned up, two, you know what the risks are, and three, if you are buttoned up and you know what the risks are, you're fully defensible if you take that path. And so anyway, just another PSA out there. Yes, this recording is available later. I'm glad that you asked that, Chris. It will be put up on the BGW CPA YouTube channel later on this afternoon. And Shoemaker also has their YouTube channel that you can find them. And it's SHUMAKER Law. And you can find that. So any other questions as we're rolling? We got 3 more minutes before we hit the bewitching hour. So people are kind of queuing up for that if there are any more. Andrew, you have any other kind of final thoughts and parting words?
I mean, one quick thing, which we've been talking a lot about employees and employment, and the Department of Labor recently released some guidelines about classifying employees versus independent contractors, and it's getting a lot more strict. Well, I mean, they're creating a few more bright lines, whereas, whether someone's an employer or an independent contractor. It's probably always been the case where, a lot of people classified as independent contractors should be employees, but it looks like they're taking a, more bright line approach. Essentially, if you're controlling work hours, or essentially the independent contractor doesn't have any work outside of you, or doesn't, negotiate pay, or, things like that, they're probably, going to be classified as an employee. So that's just, be careful with that, because especially if you have a seasonal business, pay people a small amount of money, it's tempting to put them on as 1099s. And that's a discussion you have to have with your accountant or lawyer. But just know that's out there, and review with your professionals if you need to.
Yeah, that's a great point. Oh, also, this question came in on the chat, and it looks like the answer went only to us as panelists. So the question was this: my business has less than 50 employees. Does that form that Andrew referred to apply to supplemental programs such as AFLAC or Colonial? And the answer was no, those are all for the benefit of the employee and typically paid by the employee. So you don't report those on the health insurance form. So hopefully that answers. Next question: what is the penalty for businesses in the situations that we have contractors versus employees?
Yeah, generally what happens, you undergo what's known as a worker classification audit, and the IRS would do it, and then there would be back employment taxes, because if you have an employee, you pay, one half of their employment taxes, and the employee pays the other half. And then also there's generally penalties associated with that. So I forget if it's just the general 20% penalty, or if it's, something else, but there would be both back employment taxes and penalties owed.
All right. Well, we are 1 minute away. Any other last minute under the wire questions that you guys want to have while we got Andrew? Andrew, thank you very much, by the way, for taking time out of your busy day to do this. it always provides value. It's always good to see you too. And I always love hearing your perspective on stuff. So, all right.
Yeah,
Well,
I
go
was going
ahead.
to say thanks again for having me. And if anyone thinks of a tax question afterwards, obviously feel free to reach out.
Yeah, connect with Andrew on LinkedIn, or you can find him at Shoemaker on their website because he's listed there. You're welcome, Deborah. Thank you guys for joining us. Adam, always good to see you. We'll see you next week, Lord willing, week 194.
That's right. See you guys.
All right. See you guys. Bye-bye.
Bye. See ya.